Have you realized that before you know it, we are in the fourth quarter of 2022 this year, and that means we are less than 2.5 months away from the next year, 2023. And in more recent news, the S&P 500 has closed below the $3,600 level with a negative 25% return year to date. So for those who started investing during the start of 2022 as a New Year's resolution, maybe some of you may feel a bit disappointed and a bit dejected. But nevertheless, I still feel that the S&P 500 is one of the most diversified and beginner-friendly instruments that everyone should start investing or dipping their toes into, especially if they are investing for the long term and dollar cost averaging throughout the peaks and the troughs of the market. So in today's episode, let us explore how you can use your cash, your CPF, and your SRS to invest in the S&P 500 Index, which includes 500 of the leading companies by market cap within the United States large cap equities. First up, let's start with cash investments. And for cash, the good thing is it is really versatile. You can use your cash to invest in a variety of instruments, but to really invest in the S&P 500 Index, you can invest in a tracker ETF known as VOO. Now, VOO is started by Vanguard, which runs a lot of various ETF, and VOO being the ETF that tracks the S&P 500 Index. Anyway, fun fact of why the ticker is called VOO, because V is the Roman numeral for 5, right? And then OO for 00. So VOO stands for 500, which mimics the S&P 500. So why invest in VOO is because it has a relatively cheap expense ratio of 0.03% per annum. That's the management fees paid to Vanguard for them to secure this ETF for you. So whatever that you are investing in VOO will track the S&P 500 Index very closely. But you know, despite it being really cheap, really good, and really accessible to a lot of various class of investors, there is a fundamental very bad thing for Singapore investors because it's listed in the US market, and that means that it will have a 30% dividend withholding tax. What that means is that for every $100 of dividends that you receive, you will need to withhold 30% that is held off by the broker to pay to the US Tax Council. And whatever there is remaining, which is the $70, will then be credited to your broker or securities account. So that's how they withhold the tax on the dividend side. Not only dividend withholding tax, US listed equities also have to suffer from estate taxes, which can go as high as 40% per individual. That means that if you one day leave this earth peacefully, then the US have to take 40% of your invested US equities and pay it to the government, and returning the 60% to your descendants or your beneficiaries. So then you may ask how to invest in VOO from Singapore. And one of the best ways to invest in VOO is using the sponsor of today, Webull. Halloween is coming really soon. But you know, that's not the most scary part. The most scary part is inflation. And you know that the US has just released their Consumer Price Index, or CPI, and the rate is as high as 8.2% year over year. So you see, everything around you is really increasing in price, becoming more expensive, and the only thing not increasing is your salary. And that may be the most scary thing. So you may ask, what to do? How? Well, I can answer you to sign up for the Webull Singapore Securities account right now and start learning how to invest so that you can learn to beat inflation with investments. What's more, Webull is even giving you $130 worth of free Tesla shares when you start investing with them. Even greater news is that Webull has recently launched their Good Deal Cancelled order feature, which means that you don't have to key in your orders every day anymore if you really want to catch the lowest price. So hurry up and sign up for a Webull account using my referral link down below to get your free $130 Tesla shares. Alright, another thing about Webull is that it charges zero commission fees and zero platform fees for US stocks or ETFs, so you can really invest in really small amounts even in VOO. So how do you actually reduce the tax impact that is given by the dividend withholding tax of 30% coupled with the 40% estate taxes? That's where you can look at another ETF that is called CSPX. Now, CSPX is another ETF that tracks the S&P 500 Index, but the difference between this and VOO is that it is listed in the London Stock Exchange and domiciled in Ireland. That means that the dividend withholding tax will be reduced to 15% instead of the usual 30%. Also the fact that because it's listed in London Stock Exchange, it will not have any estate taxes because that's applicable to US equities only. But you see, the thing about CSPX is that not every broker will offer that because not every broker has access to London Stock Exchange. But you know, one of my brokers, Interactive Brokers, happens to have this access. So if you really do want to invest in CSPX, you can try to apply for an Interactive Brokers account in my description below. But CSPX has a slightly higher expense ratio, which is 0.07%. That is slightly higher than the 0.03% by VOO, right? But because it's in London Stock Exchange, it doesn't have all the dividend withholding tax. So I think the savings are worth it, especially if you invest in large amounts. How much is then considered a large amount? I would say the benchmark is more than $500 per month, because if you are doing dollar cost average below the range of $500, you do need to realize that IBKR or Interactive Brokers will charge a $2 of conversion fees per transaction. So if you're trying to convert SGD to USD, you already have to pay $2 for your currency conversion every month, and that's like 0.4% already before you actually started your dollar cost average. So I felt that if you're investing below 500 USD, don't go for CSPX, okay? Especially if you're dollar cost averaging, because the currency conversion fees will eat up into your margins. So that's for cash investing, right? Either you invest in VOO using Webull, or you can invest in CSPX using Interactive Brokers. How about SRS then? Now for SRS, I will offer two suggestions, one of which is to go through Endowers and buy their Amundi Prime USA fund. Now Amundi Prime USA funds is relatively new. It was just launched like a few months before, and it's specifically for cash and SRS only via Endowers. CPF not open yet, later we talk about it. So what Amundi Prime USA funds do is that they will track the largest US companies within the US market, okay? They do not track the S&P 500 Index, that's something different. But you see, the S&P 500 Index will track the largest US companies, right? That's what Amundi is doing as well. They invest in the same large and mid-cap US companies that are also tracked by the S&P 500 Index as well, but it does not directly track the S&P 500, so there's a little bit of difference in the tracking. So the total expense ratio, if you were to invest in the Amundi Prime USA fund via Endowers, is 0.35%. It is made out of 0.05%, which is the expense ratio for the Amundi Prime USA funds, and 0.05% is relatively cheap, right? I mean, compared to other kinds of ETF, even the CSPX is charging you 0.07%. But where does the other 0.3% come from? This comes from the excess fees, the fund management fees that is set by Endowers. That's their pricing, right? Every year they have to charge you 0.3% per annum to help you manage or bring in this product to you, because Endowers is a business as well and they need money to sustain that business. So you need to pay them 0.3% per annum. So the total expense ratio to invest in a Amundi Prime USA fund via Endowers is 0.35%. But what if you don't fancy every year giving them the 0.3% per annum fees or any other robo-advisors, right? Then I suggest the other option, which is to invest in the S27 ETF that is listed in Singapore. Now the S27 ETF actually do track the S&P 500 Index, and it has a relatively cheap expense ratio of 0.09% per annum as well, slightly higher than CSPX, but because it's listed in Singapore, that's why you can actually use your SRS funds to invest in S27. And one of the brokers that allows you to do this is Poems by Philips Securities, and you can actually sign up for a Poems Cash Plus account using the link down below, because it will give you some referral rewards as well. But the main thing is that Poems Cash Plus do not have a minimum commission when you want to invest in the Singapore market. The commission rate is around 0.08% per order, and it charges a one-time fee. That means that every order that you transact, then you will pay them, okay? And I've tested out before, the net transaction fee or commission fee after all the additional charges charged by the SGX market is around 0.2% per order. So you have to take that in consideration. But the good thing is you don't have to pay the fee every year. So it's really unlike Endowers, right? Where if your sum gets larger, your invested amount gets larger, your portfolio gets larger, the amount of fees that you have to pay will increase significantly as well. Whereas if you invest S20 2027 via Premiums Cash Plus, you just have to pay that one-time fee at that point in time. And even if your portfolio grows larger, you don't have to pay like recurring annual fees. So that is some really significant cost savings for you, right? If you want to invest your SRS. So you can either look at investing in the Money Prime USA funds via endowers, or go through S27 via Premiums Cash Plus. That's for your SRS investing options. But how about for CPF then? Because we know CPF has so many rules and regulations, and if you really do want to invest your CPF, you need to have at least $20,000 in your ordinary account before the additional funds above 20k can be invested. So for CPF investing, one way is to invest through endowers again, is the Lion Global Infinity US 500. It's a unit trust that tracks the S&P 500 ETF. And I've documented my Lion Global Infinity US 500 portfolios like for 2 years soon. Okay, so you can look at the update there. Obviously, it's not doing really well in 2022, and that's the only way that you can invest your CPF in the S&P 500. I don't think there are any other ways as of now, the current date. So the only way to invest your CPF in S&P 500 is through endowers and to buy the Lion Global Infinity US 500 fund. Now, how much do they charge then? If you remember, it's the 0.3% excess fee charged by endowers. That's for the Fund Smart strategy, which is 100% into a single unit trust. Okay, that's 0.3%. Add on the fees that you have to pay to Lion Global Infinity. So Lion Global do charge a 0.34% per annum. So if you add 0.34% of expense ratio to 0.3% excess fees of endowers, you get a total of 0.64%, which is really expensive, right? But you think about it, there's really no alternative for you to invest your CPF in any other kind of US listed ETF. So endowers or Lion Global is really the only funnel for you to do that for now. Of course, if there are any other cheaper ways for you to invest in S&P 500, even through a Money Prime US funds that may be available to CPF in future, then I'll inform you guys up. But most importantly, you have to join the Telegram group, because that's when I will update my latest news before I make any video. Okay, so you can get the first-hand information of all the investing related news, or the best hacks, your best credit cards, or even CPF stuff on my Honey Money SG Telegram group. And if you are really nosy about how my other CPF portfolios, investing portfolio has performed, then I can refer you to my Money Hour and Endower CPF investment portfolio update right here, because it will show you how horrendous this year the market has been, and you can then laugh at my performance.